Great. So we're going to move on to investment, which has been a theme throughout the day, but we haven't.
We've been already talking that.
Huh?
We've already been talking money and capital
Right.
and stuff like that.
Absolutely.
We've been
It's a
talking
good segue.
time, talent, treasure. Time, talent, treasure. There you are,
Yep.
the three things we've been. So Sundar, let me start with you. So this is a very different business from investing in software, right? What signals do you look for to decide whether a technology is ready to reach the market and not remain in the lab?
Yeah, I mean, I think semiconductors definitely very hardware and very capital intensive. I think we just talked about this in the earlier panel. If I were to kind of pick, 2 or 3 themes that, as an investor we look for, I'm part of both Temasek and Zora Innovation, which is an incubator arm affiliated with the Temasek ecosystem. So we look for a few things, right? Especially in a very deep tech hardware type of a startup, you got to index the founding team, right? They have to be, pretty technical to begin with. But more importantly, if they've had experience in bringing ideas to life, that's in their prior life, that's very important to note. Or at least, have got some experience in the corporate or any other space where they have brought some ideas to product to commercialization. That's important. Let's say if the founding team kind of lacks that, then we look at what about their, advisors, or even some strategic investors who may have had that kind of an experience where they have brought certain, such startups to commercialization. Really, if you kind of don't have either of these, and if it's a really small, early stage startup, the founding team is largely, academics and maybe some really super bright grad students, and if they have early stage only financial investors in it, then we see them as a slim chance to invest. So that's really important. So that's number one. Indexing the founding team. The other thing that's important in this industry, as we heard, getting this out the door for creating value, you got to go and check whether there is keen interest in downstream players. Depending on what your startup is. Let's take an example, which we talked about. AI chipless fab companies as a startup. There's a lot of those, right? So in that case, you want to see, is there a real pull from the foundry partners, the IDMs, ODMs, OEMs, ideally, even in this example, let's say hyperscalers, are they pulling for this type of a technology? So you kind of have to look for, is there pull? Because that's very important, because without that, you can't just go unilaterally try to get something to commercialization. And how do you measure that? Right? How do you know there is pull from some of these players? There are ways that we look at from a diligence standpoint. For example, do they have structured JDAs, joint development agreements, with some of these downstream partners? That's an important indicator. In some cases, are they doing some paid NRE work, right? That's a skin in the game early enough because it's pretty capital intensive. Maybe look for proof of concepts that you're comfortable with. So those are some of the things around, I would say, downstream interest, right? Maybe there's one other thing that I'd like to add. What we look for is maybe 2. One of them is, hardware semiconductor products, they cannot just bring 20, 30, 40, 50% improvement. It has to be an order of magnitude. Performance gain, order of magnitude. We talked about energy, order of magnitude, energy efficiency gains, ideally an order of magnitude cost. But if it's really, super technology performance play, then, at least at cost. Right? Because the barrier to enter in an incumbent market is incredibly hard. I mean, there are so many fabulous companies. They all are building their own designs, to combat how the accelerators work. But there is a big behemoth out there in this market space. So if you have to really, compete against those hardware, then you really need to have an order of magnitude. So we look for, is there an order of magnitude performance benefit that you can get and power efficiency benefit? And I think the last point that is super important also is around MRL that we talked about. We want to kind of see a line of sight. Is this a yieldable technology? Is it a manufacturable technology? Or is it something that's going to really look good in an incubator stage and it can't really take off? So I know some of these are common themes for any investor looking at startups, but particularly for hardware in semiconductors, those are the 4. So really indexing the founding team, making sure there is some downstream interest, there is keen pull, performance orders of magnitude, at least one order of magnitude, and manufacturability. So those are some of the themes we look for.
Thanks. So Ken, pick up on that a little bit and talk to me about how you evaluate and take what distinguish between what could be a science project and what's a real company. I mean, what signals are you looking for there?
Yeah, absolutely. I think in terms of scientific projects versus technology that has reached proof of concept or product that is close to commercialization, it's about the time scale, right? When I look at the project, I would have an estimate in terms of, for scientific project, it probably take you 8, 10, or maybe more time in order to get to the market. I'm more focused on the commercialization part of it, maybe because I invest mostly in Asia. I come from a corporate background, which we are more strategic in terms of investments, and it's typically strategic investments that we do. I think there's sort of 3 areas that I look out for. Number 1, you're really focusing on solving a specific and real problem. And when I say real problem, it needs to be, versus a team of founders coming to me and telling me that, we have a technology breakthrough, versus a team of founders coming to me and saying that, we're solving a market problem with technology X for customer Y. So the latter will be more interesting for me, and it's closer to the commercialization stage. Actually, there's a story about, real in double quotes that I encountered like 10, 15 years ago now. So smartphone was growing at that time. It was right at onset, 2008, 2010 timeframe. And then there's an app that came out in China called Meitu. And all it does is it beautifies you when you take a picture.
Nice.
And I took that back to the UK. And I told the guys in the UK, and I say, this could be a potentially killer app. Computer vision application in a smartphone. And my colleague he couldn't get his head around it. Either our Europeans are all beautiful people, or, the smartphone will go into overdrive trying to beautify him. I don't know. But he couldn't get his head around it. So when I think about real problems, I also think about, some problems are global and some problems essentially local. But today, if you take out your phones, especially Android phones, beautification feature is enabled. iPhone, you might have to go and enable it, but give it a try. Okay. So real problems, double quotes, that fits into what the market needs. Number 1. Number 2, I'll be looking for a clear route to commercialization, and most importantly to that, it's not the traditional product market fit, but the founders team ability to fail fast and fail forward. So you would have potentially engaged 1 or 2 customers. Yep. You'll be talking about what the customer wants, and you are prepared to quickly knock out a prototype if possible. I mean, for semiconductors, right, you can't get the chip out within a 6 months period, but you can build FPGAs and stuff like that to get it out. So fail fast, fail forward. So just to give you a sense of time scale, so during the smartphone and sort of tablets wave, I was very active in Shenzhen area, because that's where all the cheap knockoff smartphones and Android tablets were coming out. There was a huge demand at that point, because there was 3 billion customers in the developing economies that are looking for low-end phones and low-end tablets. There was demand. And so in the West, mobile chips takes about 18 months to 24 months to design. So the TI then, the Marvell then, and the speed in which the Chinese are knocking out the mobile phone chips, they shorten it to about 9 months in that design process. So I think the point here is they are prepared. Well, first of all, there's a demand at the low-end market, which is less concerned about the quality. If the chip fails, just power on and power off. It's not going to hurt with your tablet or smartphones, right? But they iterate very, very fast, and very quickly they catch up. And during that period, Renesas mobile shut down, Marvell mobile shut down, TI mobile shut down, and a few Chinese companies emerged. So I think we need to think in terms of the context, because in the semiconductor world, it's highly competitive and it's highly market-driven. And you need to figure out how to get into the supply chain, get into the market that helps you speed up your testing. So that's my second point. And the third point is scaling up. And I think that's quite straightforward. In order to scale up, you need to work with your ecosystem partners. I will be looking for founders who has connected to some of the ecosystem partners, to the supply chain, or at least you have investors that are on board that can help you network to get connected into that space. So I guess all in all, semiconductor startups are hard. I'm involved in 3 in Singapore. I'm focusing on figuring out how to help Singapore build up an IC design ecosystem. There's very few. There's a number of MNCs. Thank you, Infineon, NXP. They have a design team in Singapore. And it's very hard and capital intensive is all that. But trying to find that market gap, that you go in and just fill in that gap, that's really, really key. You can do anything generic, it's pointless. It's a very specialized field in semiconductor.
So we're going to take a step back, because David, you invest at Be Able in technologies while they're still scientific projects, right? Well, they're papers, published papers. How do you decide what to take a risk on or what to be interested in?
Well, basically, as a venture capital investor, it's pretty similar what they have done. Basically, there are 3 main factors that every investor analyzes. The first one is the team, is core. But in this kind of technologies, I'm going to comment some point. The other one is technology, and the other one is the market. So if I'm going to explain very fast what we do. Basically, we are a venture capital firm specialized in investing in really pre-seed and seed stages from research centers. Is what is normally called technological transfer funds here in Europe. So we have raised, we are managing right now around 85 million euros in several funds. We start investing in low TRLs. Normally, we start investing in TRL 4, 5. I would like to invest in TRL 7, but the realistic is that when you identify technology that is disruptive, they are in TRL 4, 5. And of course, MRL, a little lower due to the fact of the situation. We are specialized in investing in what is called deep science. Okay, we are going to discuss what is deep tech and deep science. Deep tech right now, everybody knew what is nanophotonic, microelectronic, whatever. But in the last, everybody is talking that deep tech is artificial intelligence. So we have to differentiate very clear what is digital deep tech, that is artificial intelligence, blockchain, data mining, all these algorithms. And in the other side, we have the industrial deep tech, what is called deep science. That is what semiconductor is. Nanotechnology, photonic, micro nanoelectronics, that there are some really relevant points that is completely different investor asset, different to the digital deep tech. So we are going to focus on deep science. So we focus on deep science, investing in deep science in really early stages. Why we are different from a venture capital? Because the venture capital investing in deep science, they look for traction, commercial traction. When you have commercial traction, you are in the second validate that Antonio has shown in the figure, that you are looking for 20 million euros and you are running up. But the first part of the debt valley, the first value, this is the necessity of uses are so huge, and it's not valid the typical venture capital, traditional venture capital that is business angel, family office, whatever, that it invests in something, you have an MVP, and after you start raising money in the next stage with the venture capital. So it appears this kind of asset that is science equity fund that invests in really early stages. And this is where we are. And the question is, okay, if a venture capital has no possibility to identify what is the market traction, what can I do? So I have the team, the market, and the other one is the technology. So how can I identify the market? I have to, when they present us the technology, the future market that is going to address has to be huge, has to be incredible. Because if I don't have an incredible...
So give us an example of one.
Well, when you call about superconductors, you told me, he has a company that he has raised 200 million?
300.
300. Peanuts.
What's 100 million here?
For developing a chip for automotive.
Automotive chip.
A specific application. Yes, he has the application. The application is how many billions of chips are you going to put in the market? That is the application. When you, okay, let's try to focus on developing this chip in order for this application. So let's go up. We have the application, huge market. The second is the technology. Okay, we are going to develop the technology to came from TRL 3.4 of that you are in the lab to the next stages. And this is the due diligence process that is really high for us because we have to analyze no competitors because competitor will be. And I understand that there is no competitor if my technology is better. The question is, what are the substitutive technologies that can appear in 5 years and that can kill my technology? That is the really important. And we have to make analysis, due diligence in the case of patent, publication, IP protection. How do we do that? This is really important.
Yeah.
We have market, we have technology, and we have the most important, the team.
The team.
Yeah, and that is a problem. Because when you try to jump from the research center to the private, you have a frontier from public, because normally all research centers came from public to the private. And there is a frontier that you have to just jump. And the only vehicle that we believe that is possible is creating a startup, an SPV independent, to consolidate the transfer of all the knowledge to transfer to this vehicle and to generate an independent vehicle to traction the market. So normally you have to get people from the research center to jump to the company and to make one of the most important things, that is what we have been discussing before, is to retain people. Because people stay in a company more than 7 years with a small salary is not happy for anybody. So what is the retention plan? You have to incentivize a stock option or whatever. And all of that make possible when you create a startup and you are able to take the decision to invest in this kind of
So those
company.
stock options are a huge retention
It's
tool.
huge. Yeah, I don't know in your case, but in my case, everybody can because they have phantom share, stock option, action.
Right.
They want to be part of this unicorn.
Right. Sundar, I mean, hardware requires patient capital. Talk to us a little bit about the investment models that you see working.
When you say investment models like financing, funding models, So I think, and obviously, early stage, you definitely want to have a right early stage VC, right, in the private space. It'll be really nice to couple that with some non-dilutive public funding as well, because that's kind of what you need in the hardware space, especially because it is, even getting started is fairly capital intensive. And then down the road, when you're ready to kind of scale up or even whatever we call Series B or Series C, then you could then look for VCs that are more growth capital focused, and that's why you need to write bigger checks, right? So definitely that's like a very typical traditional funding model. The only thing that I would add here is if you can go and tap into some non-dilutive grants early on, then that's really, really helpful, because until you know what value you're going to unlock, you really don't want to give away some of your equity. So be looking out for opportunities for building that non-dilutive funding as well, usually from public sources. The other thing, there are large, obviously, financial investors, such as Temasek, that have a huge portfolio and a large amount of AUM. These are very attractive for one particular reason, and I can speak this from experience. They almost always invest on technology first principle, and inherently these large financial investors are in it for multiple rounds, right? So if you can kind of tap into them, you're going to get through Series A, Series B, or B, or C, because that's the patient capital part, because they have the wherewithal, and not only they give you that level of comfort. Of course, you have to execute, But with them, it kind of comes an ecosystem of connections in the industry and similar like-minded VCs. I mean, that catches on fire, right? I mean, all of a sudden you have a large financial investor, putting some money in it. It draws this effect of network effect, as you want to call it. More people want to put in, and that puts the startup in a much, much better position, particularly for valuation and so on and so forth. I would be remiss if I don't talk about corporate ventures, right? That's another funding model. For an early stage startup, if I can just be bold and say, resist corporate venture fund capital, because usually it's good because they're going to part with money, but it also comes typically with some strings attached. And more importantly, they may end up steering direction of your product in a direction where you may get locked in for a period of time, and it may not be accessible for everyone in the ecosystem. So that's an important one to watch out for. You still, obviously money is money. As a founder, you're going to take money from anywhere, but be mindful of how you structure those rights when you do take money from a corporate venture. However, if you're kind of in the mid stage, CVCs are a great strategic investors, because in addition to the capital, now you have connections because you're at a stage where your business is kind of getting out. You want customer penetrations. You actually want high-level customer executives who are pulling for your product within these various end markets. And usually corporate ventures are able to go and build those connections for you because they've worked with those ecosystem for many, many years. So I think those would be some of the ones that come to mind from a funding model standpoint, Francis.
I want to sort of go back in, your experience at the interface of Arm and the Chinese market, and ask if there are lessons that you've learned there that apply to European deep tech startups that want to scale globally. Are there ways you can help us think about that from this European perspective that we're driving towards at this event?
Okay. Yeah, perhaps not entirely specific to Arm, but taking a 30,000-foot view from a framework standpoint, I think, so first of all, entering the China market or any market per se, it's about really understanding what your goals are, right? And from a China perspective, having engaged with Arm and other MNCs as well and consulting firms, typically, for MNCs from the West entering China market, you either go in for a market access, you either try to get close to the supply chain, or maybe you are co-developing technology for localization, and so on and so forth. So trying to really understand your goals and why you are entering the market. But secondly, I think there are a number of factors that you should consider when entering the China market. So typically, localization, and how are you going to do that? Speed. How does that impact your operations outside of China? And IP protection. So those three angles usually, we spend time exploring those three angles in depth before figuring out some sort of a model to enter. So I think the models, there are, I would say, 3+1 that I've seen over the last 15 years. So the first one is pretty obvious. A large MNC entering the Chinese market, they set up a fully owned subsidiary inside China. And with that structure, a lot of the decision making goes back to the HQ, and you hire regional managers to do sales, engineering, so on and so forth. And often with this model, the localization and the speed part is always weaker, in order to be chasing the market and stuff. The second model that we've seen, that I've seen, and it's actually happening over the last few years, is European MNCs as well, semi going in. What they're doing is they establish a structure which is still 100% ownership from the European side, but they appoint a president and CEO, which is Chinese locally, and then they have a board for governance. So you are actually delegating some decisions down to speed up localization, decision making. So you have a structure in which you manage that, but allow sufficient independence for the company to operate inside China. But you're still 100% owned. And then the third model that we see often, especially in the automotive industry, joint ventures. Happened 20 over years ago, and we're starting to see joint ventures, which you get to a point where it's so the ARM China joint venture is a 51-49 structure, where Chinese financial investors own 51, and then ARM owns 49%. To a large extent, you are recognized as a Chinese company by the supply chain. Yeah. There was talks yesterday about how the government could actually help. Especially, I think we could learn from the different what other countries are actually doing for Europe. So actually, the government are actually instructing the industry to localize their procurement content. It's happening in Malaysia. It has been happening in China for a long time. So I to say, they're saying buy from, and they increase that percentage. And then I think those are the three models that we see, and then there's a +1 model that I'm seeing more recently as well, because a lot of the Chinese companies are globalizing, so they are going to neutral regions. So Southeast Asia is seeing a lot of Chinese auto companies landing in Malaysia, semi companies landing in Singapore and Malaysia, some coming to Europe as well. Operating as a neutral region is an opportunity to partner with the Chinese company as well, where the IP protection law is much more solid, and how you would partner with them in these neutral regions, but indirectly gaining access back into the Chinese market. So that's kind of the broad observations that I've seen over the past years.
Thanks. So David, let me ask you as well about the deep tech success stories you've seen, and whether there are common themes there that you think are relevant to this European ecosystem we've been talking about.
Common theme in the European.
Yeah.
The question is, what is success to identify? Because for me, success
I'm going to let you define it.
If as a venture capital firm, I invest in a company, and if success, if I get a higher multiplier. So, right. For a venture capital firm is to get the return that I expected. But for European government, if I sell the company to a US company or a Japanese company, it's a success or it's a failure.
Right.
So, yesterday Juan was showing here 20 companies, 25 companies of the bigger capitalization over the world, and I don't know if there was someone from Europe. No one. That is a problem. That is something really, really,
right.
really dangerous.
I can see one.
And it's
going
not
for
only that the first company, which I think today is ASML.
It's 25, 27.
Right. It's like less than 500 billion. But the next one, I mean, until you get to the next one that is technology, I think it's the first one, the next one is SAP. Before that, we have Novo Nordisk, LVMH, Sanofi, and other. So there's no big tech.
Right.
So the question is, should European government trying to accelerate and to create unicorn to stay here in Europe? So the question is, how can you success be to stay here in Europe and not to be sold to the big companies in the rest of the world? That is one of the big concerns that right now is being discussed in European. So there is big amount of money that they are trying to create, first of all, fund of scale up, and the second one is scaling up process fund in order to keep the company here in Europe. And that is one thing that has to be one of the things that we need to analyze. For example, the second one is I'm really defender of venture capital industry. Why? Because the venture capital industry is necessary to develop a specific industry. For example, if we are creating semiconductor industry, if you don't have venture capital industry, it's very difficult to achieve the consolidated market that they have. For example, one of the examples of the venture capital thing that industry has revolutionized everything is Israel, 20 years, 40 years ago, and the second one, of course, USA, that in 1918 they invest a lot of money through the insurance companies and they revolutionized the venture capital. And it's clear that the venture capital industry is monetizing and is developing the industry that they invest. Right now, US venture capital industry is around $300 billion per year, and in Europe we are in 50 billion euros. So we are one sixth part. But if you analyze the numbers when you are investing in early stage phases, the gap is higher. So this is something that we have to fight in some ways in Europe, creating additional funds. For me, the success stories, at least according to the question, for the companies that I analyze that is a success and is interesting for me, and what are the components that they have in common, basically, most of lenders, all of them have include venture capital in their shareholder. So the venture capital is helping to grow very fast, raising money. So that is something that when you want to create an unicorn, you have to think in venture capital, always. Europe has to create fund for the next stages, but this is a obligation for them. And the other thing is something that they have commented before, and for me it's important, is to speed up the process of prototyping and to reduce the risk in the really early phases. That is critical, is to be really, really near to the customer, to know what they need, and to create clusters and hubs of innovation to reduce as much as possible the cost of prototyping and the cost to achieve the market, because the time is money,